Picture this. The ground under the economy is humming, quiet at first, then you feel a faint tremor, and a second later, someone nearby drops a glass. That small crack you noticed? It might be nothing. Or it might be the first whisper of an earthquake that, by the time sirens wail, you wish you had taken seriously. That is what a yield curve inversion feels like. Subtle, technical, but with a track record that demands attention. Let me take you through this in plain spoken words. No spreadsheets on screen, no jargon that needs a decoder ring. Just a clear human explanation of what's happening, why experts keep checking this signal, and what you might do about it. First, the simplest picture I can give you. When you loan someone money, you expect more return if you tie your money up for longer. It's common sense. Lend me 1 year, I'll pay you a little interest. Lend me 10 years, you expect more. That normal upward slope, short rates lower, long rates higher, is the healthy economy. But sometimes the curve flips. Short-term rates climb above long-term rates. That's the inversion. It's like the economy is saying, I'm worried about the next year, so I'll pay more to borrow short-term, and investors will accept less for locking money up long-term because they want safety. It is a fear signal. And historically, when that happens, a recession has often followed within the next year or so. Now, pause for a second. Think about the last time you heard about a financial warning and shrugged. This one is different because it's not a rumor or a headline. It's a simple relationship between interest rates, a relationship that has flipped before every major recession in the last 50 years. That alone is worth our attention. Let's walk back through history for a moment because patterns teach us. In 1928, the curve inverted while people were still celebrating the boom. Banks were lending like there was no tomorrow. People bought stocks on margin thinking the gains were permanent. Sound familiar in mood, if not in details? 18 months later, the market crashed and the system collapsed into the Great Depression. Jump forward to the mid-2000s. The curve inverted again, housing prices were climbing, and lenders wrapped risky mortgages into shiny bundles. When confidence broke, the whole global financial structure shook in ways few expected. Both times the curve inversion was a warning light. Not the whole story, but a crucial part of it. So why is today different? Or more worrying than those earlier times? For a few reasons. 1. The sheer scale of debt now is enormous. Governments, corporations, households, everyone is carrying more. 2. The speed at which markets react is turbocharged. What once took days to ripple across regions now travels in milliseconds through electronic trading, algorithmic strategies, and global linked funds. 3. New kinds of risk exist now. Cryptocurrencies, complex derivatives, shadow banking structures. That didn't feature in earlier crises. Combine those with traditional ones and you get a system that's more tightly woven, and therefore more likely to tear in surprising places. Another big piece is how central banks have behaved since the 2008 crisis. To prevent collapse, they flooded markets with cheap money and held interest rates low for years. That policy saved economies then, but it also fed an appetite for cheap credit. Corporations learned to borrow instead of invest. Stock buybacks replaced investments in factories and research. Cheap loans fueled speculative bubbles rather than productive growth. The economy became dependent on the steady drip of low rates. So when rates move up or when short-term rates cross above long-term rates, that dependency shows its weakness. Let's not sugarcoat the social side either. The labor market looks stronger on paper than it often feels in people's day-to-day lives. Official unemployment numbers can hide discouraged workers who have stopped looking. Many of the new jobs pay too little relative to local housing costs. Retirement accounts are stretched thin. People have fewer safe places to put savings that earn meaningful returns. When the next downturn hits, it's not just balance sheets that suffer. It's families, homes, medical bills, and faith in institutions. Here's a practical way to think about what the yield curve inversion might mean for you personally. It doesn't dictate the exact timing or the magnitude of a downturn, but it raises the odds that one is coming. That shifts the sensible question from panic to prudence. How do I reduce unnecessary risk, protect what matters, and keep options open? A few concrete moves that are worth thinking about. Diversify rather than concentrating everything in one asset class. Reduce exposure to high-interest or adjustable-rate debt where possible. Build a modest emergency fund if you can, and be realistic about income sources and job stability. If you hold a lot of paper assets, consider the time horizon. Short-term market swings and a potential recession can be painful if you need money soon. If you're retired or nearing retirement, adjusting the mix of assets to reduce downside exposure is often wise. And if you own a business, model a few worst-case scenarios and have a plan for cash flow stress. Quick pause. If you're finding this helpful, please like and share so more people get this explained without the noise. It helps spread the word and keeps the conversation honest. Now, here are some attention-grabbing facts to keep in mind as we go deeper. Watch for corporate signals, rising use of buybacks over investment, growing shares of bonds that are rated as lower quality, and banks posting profits that mask rising loan loss reserves. Labor market indicators to watch include wages relative to cost of living and changes in labor force participation. Politically, expect pressure on policymakers to act quickly when the pain starts. But remember that policy tools are more limited now than before. I want to mention one thing that changes the math: the global role of the dollar. Because the dollar is the primary reserve currency, U.S. monetary policy affects economies around the world. When the Fed raises rates, countries with dollar-denominated debts feel the squeeze. When the Fed prints money, it can export inflation. This global reach means a U.S. financial problem can quickly become a global one. It also means national policymakers may face conflicting pressures, making coherent responses harder. Let's talk about the psychology behind risk. People increasingly expect authorities to step in and prevent losses. That expectation breeds risk-taking. When safety nets appear to be automatic, markets take on risk that looks reasonable until it isn't. That moral hazard is subtle, not the result of a conspiracy but of a pattern of behavior. When the music stops, many will realize they were playing a game with fewer rules than they assumed. All this leads to 3 practical themes for surviving a potential financial earthquake: awareness, resilience, and calm action. Awareness means understanding the risks without letting headlines decide your life. Resilience means building buffers, financial and personal, that reduce fragility. Calm action means having simple plans you can execute without panicking, like trimming high-interest debt, having a liquidity buffer, and checking that critical payments are covered. You don't need to become a full-time market watcher to be prepared. You do need to pay attention to the signals that matter, and to avoid the trap of thinking someone else will always fix the problem for you. The yield curve inversion is a loud signal precisely because it doesn't care about politics or spin. It's just a relationship between rates that, when flipped, has historically preceded trouble. Before I wrap up, I want to invite you into the conversation. What worries you most about the economy? Are there steps you've already taken that helped you sleep better at night? Drop a comment below and let's compare notes. Your experience might help others adapt and learn. Conversation helps everyone think clearer. To close, the yield curve inversion is not a guarantee of disaster, but it is a strong warning light. The world today is more indebted, faster, and more interconnected than before. The policy tools that helped in the past are less potent now. That combination raises the stakes. The question is not whether to fear, but how to prepare intelligently. Protect liquidity, reduce unnecessary leverage, and keep close watch on job and debt signals. If you take sensible steps now, you'll be in a better position, whether markets wobble or hold steady. If this gave you clarity, please like, subscribe, and ring the notification bell so you won't miss updates. Thanks for watching, and stay steady out there.